An investment is a sacrifice of current consumption for expected future gain. And I remember I was in a class at UC Berkeley in about 1974 or 5. And when I think about it, it's a gamble is quite similar. It's just that you have still a sacrifice of current consumption but you have in an expectation of losing. And so I want to show you what my first investment was. Going to Lake Tahoe. I lived in the Bay Area near San Francisco, and I took $500 and I went up and made an investment. I played and that investment continued. I actually ended up playing for 5 years, 50 days a year, 8 hours a day, about 100 hands an hour. The dealer deals 360 hands an hour. And if you play one-on-one, you get about 180 hands an hour. But on average, you probably end up with 100 hands an hour. That ends up to be about 200,000 hours. Now, during this time of these 5 years, I had a full-time job, but 50 days a year was about all I could do is get to Nevada. And I had lots of capital fluctuations in here. And as important as it was to get an advantage, it was more important to figure out how much of my bankroll I could bet at any one time. And by the end of this time, I had a bankroll of somewhere around something like $10,000, which would allow me to play. It would allow me to play 25 to 200. So my largest bet was about a 50th of my bankroll. I was involved in a blackjack team that was quite successful. And I took the money that I had, which exceeded, I know it exceeded 25,000 at that time. I'll tell you first of all about the strategy I used. And that strategy was I used a strategy developed by Ed Thorpe. And what he did is he discovered that if you take cards out of a deck, you take all the fives out of the deck, you'd have a 3.29% advantage. And that means for every $100 you bet, you'd win $3.29. And if you took all the aces out, you had 48 cards left, you'd lose $2.72. So what he did is he developed a strategy whereby he counted 2 through 6 as +1, 10s and aces as -1. And when you had a positive expectation, you bet more. And when you had a negative expectation, you bet less. And I used that strategy and took that 25,000, roughly somewhere over 25,000, and I became a market maker on the Pacific Stock Exchange. And then moved to the Chicago Board of Options Exchange. But I became fascinated with market timing, or predicting the equity risk premium, how much you get paid for equity risk versus treasury bills. And I actually presented a paper at a conference on gambling. And ironically, Ed Thorpe, my hero, was on the same panel. And I concluded during this time that, in fact, that there was significant potential to time the market, but it was unlikely that the risk-adjusted returns would compete with blackjack or market making. And it was very fortunate that I found this out, because for the next 18 years or so, I concentrated just in terms of option strategies. And the way that ended up was that it ended up that we had a quite successful firm, and we were about to go public in about early 99, and we'd filed an S1, and we were going to go out at a market capitalization that was estimated to be somewhere $300 to $350 million. And we would have sold part of the company to the public. But instead, there was this little firm in New York that said, no, I don't think you should do that. We'll pay you more. And they paid us $500+ million. So I was sort of fat, dumb, and happy at that time. And Hill came along in 2008. I think we all know about. And I was saying, this is not good. I had a pretty passive portfolio, and I lost about 40% of my capital during that time. And I said, there must be a way to avoid that. And so I turned to the academic literature, which I had turned to, I'd actually begun learning about options through academia. And I continued by reading about 300 papers, and this is a summary of some of those papers. Claimed that the returns were somewhat predictable. And we did a lot of research ourselves, and these are a few of the market. These are indicators. We have, in fact, here, this is actually a principal components analysis of price to book, price to earnings, and dividend yield. And we separated it out into the first half and the second half, and we found that the returns were predictable between those when you segmented the data. We did the same thing with the variance risk premium, and we were pretty confident that we could actually predict the returns of the market. And we actually combined about 20 different indicators, and we thought we did some rigorous work, and we published them in some relatively acceptable journals. And I was pretty confident that this would work. And so we started an active ETF, an exchange traded product. And I was even confident enough that this is what I said in 1915. Now, Jack Vogel had just come on before me, and he is the founder of Vanguard. And here's what I said in 2015.
Well, Jack Vogel, I think, was right, but the stigma market timing has gone on too long. We've had some significant changes that have occurred since 2000. We've had this explosion of data, and at the same time, we have predictive analytics that are actually permeate our lives. We have credit scoring, we have cars that drive themselves, we have police that then use predictive analytics to find out where crimes are going to be committed. So it's ironic that we can't use predictive analytics in our portfolios. Just as we have our cars being driven now by machine learning techniques, we should have our portfolios being driven by predictive analytics.
So I was pretty confident. And so we launched the exchange traded fund, HTUS, the symbol. So let's take a look at the performance of this fund. And you'll see that unfortunately we have underperformed the fund. And this could have been a variety of reasons. We have Petra Bakasova on the call, and maybe she can give us some other insights into this. This is what these are some of the reasons. But Petra, do you have any comments of why you think we've underperformed?
Yeah, sure. I think the summary on your slide is pretty good. One would be we used a number of academic variables, and they have been published. And obviously, there are a lot of academic variables that were not published. And so we're dealing, obviously, with data snooping and potential survivorship bias. Also, we could argue that we have not gone through a full business cycle. I mean, we did see a significant market decline in 2020, and our performance has actually not been so bad in 2020. But it's hard to argue that we have gone through a full business cycle since we launched the fund. Also, some of the issues could have been on the modeling side. We utilized, at least initially, relatively simple regressions to fit our models, and OLS suffers from a number of well-known issues, as I'm sure you all know. So potentially we have just had, statistical issues with the models we have been running, which hopefully could be solved by using regularization. And another potential issue that is not summed up on this slide was less with our model's ability to predict the market and more with our ability to turn our signals into profitable trades. So for example, we could have a model that does forecast the market returns better than a naive model. But of course, if you're not able to make properly scaled bets with your model, you may not be able to outperform the return of buy and hold.
Okay, very good. Thank you. So you'll see that having the right size bet is almost as important as getting an advantage in any game, whether it's a game of a gambling or an investment game. So what we did is we developed a new model, a one-day model. And our previous models were in terms of 6 months and 1 month, and so we've gone down to a shorter time horizon, and we've included a variety of things. So you'll see number in B, momentum and sentiment interactions. There's some papers coming out explaining that. We also had federal, you'll see in K, Federal Open Market Committee that occurs 8 times. So we were pretty encouraged by this this model, and it actually gave an extremely good back test, which we would expect. But then in real life, we saw that actually with paper trading and real trading, it did outperform by a significant margin. And also we found that the performance of HTUS, by incorporating this as a small piece of the puzzle, has helped us. So you can see in the last 6 months, we've, or more than 6 months, we have actually outperformed. So, and one of the things on the daily, every day, if you look at Hull Tactical, you'll see our position, which in this case was 90% long, and it'll show you the variables that contribute to that that position. So what do we do now? Well, first of all, one of the questions is, could options add to the return? Well, if options were fairly valued, they couldn't. But we don't think they are. We think there's a variance risk premium. We also think there's a skew risk premium. And the way we determined this was that we replicated, and what we did is we took each option and we hedged it over the length over a certain amount of data in the S&P 500, and we searched for what the implied volatility would be that we should have, or the break-even volatility that would create no profit or loss. And we created hundreds of thousands of those, and then we tried to predict what those break-even volatilities would produce. And what we found out was that, according to our model, calls are cheap and puts are expensive. And the reason we believe that calls are cheap and puts are expensive are that investors, we think, buy and sell options to satisfy their utility preferences. They really don't know what the expected value of these options, so they either sell calls to create more income, or they actually buy puts to provide insurance. And so we are actually adding this to our fund. So we think that in summary, the question is, are returns predictable? We think they are somewhat. The question is, are they strong enough? And we believe that options and these new indicators will actually help the performance of HTUS.